second. mm. Mm. I can't find I'm looking for is it's not. There we go. Let's make it fit the screen. Okay, cool. So I'm going to turn this down. So from about 12:30 to 1:30, we're just going to get into a pre-position, pre-end my positioning, which is where we're going to just do nothing for the next hour, but we're going to monitor, see what price is doing. We're not really, it doesn't matter what price does. We're not ever going to get engaged in the markets, generally speaking, during this time. We're going to kind of wait for the New York Open, which is around 1, but the Judas swing is what we're going to be looking for. It should happen around 1:30 to 2, where we get a first sharp move, which tends to be in the wrong direction. And the purpose of that move is to collect liquidity. Once it collects liquidity, we can then move on to the next step. But even while this is happening, whilst we're seeing the Judas swing in effect, it could sometimes even be a Judas acceptance. Not Judas acceptance, Judas, what's the terminology? Delivery or expansion. We then want to just do nothing, but want to monitor it. After this happens, around 2 to 3, which is the most important hour. This is me going off GMT. So what would that be? That would be 10 a.m. that would be 9 a.m. to 10 a.m. for New York. But for GMT London, it is currently 2 to 3 p.m. So that is what, an hour and a half away. This is where acceptance occurs, where we place our trade, where we actually have our window of opportunities from 2 p.m. to 3 p.m. After 3 p.m. is our post delivery, where the market will move slowly or it will retrace or it's choppy, and then our high probability entries are no longer valid because our strategy is to base it off of institutional trading rather than patterns we may see in the market. Now, we utilize patterns to analyze when the big players in the market, the institutional traders such as the banks and hedge funds, are actually executing their orders. But we don't trade solely positions, or slowly patterns, should I say, because patterns on their own without backing is just noise, and we don't want to trade noise. So, what is our cutoff rule? Our cutoff rule is if by 3 p.m. the London range, which is this range here, so the top of this and the bottom of this, if by 3 p.m. we haven't got a cutoff, or a, what do you call it, a sweep of either of these lows or whatever you want to call it, or highs, this range, we cut off, we don't trade. If we do have it, like we are having a sweep of these lows here, it could be a sign of a trading day. So I think that's key, because yesterday should have been a no trading day for me, but we executed, I think, 2 wrong trades, which we lost 2% in, where we could have just lost 0%. So you got to see losses as profit. Why? Or what do I mean by that? So for example, let's say if I don't trade yesterday, I save myself 2%. That is a 2% plus, because it's 2% I wouldn't have had. Like, now I'm in a position where I don't have that 2%. But if I could go back into the markets and I win 2% now, it's seen as a positive win day. So why not my losses be counted as positives if I avoid them? So avoiding losses is a good thing. Obviously, in theory, you're technically avoiding 100% loss every day, but that is true, because there's days where people blow their accounts. So I do think it's a positive where you avoid a loss. Now, it's not going to be a case where every single loss we're going to account for. We're going to account for specific losses, such as overtrading, such as times where we maybe misanalyzed the market or we didn't interpret it correctly. Those are the types of things we count as positive losses. Because no point is me giving myself credit for avoiding a strategy I never would consider anyway. For example, oh, this person, maybe I look at the market and say, this would have been a loss if I entered this breakout trade. But I'm not a breakout trader, so it doesn't count as a positive. So when I say as a positive, I'm being careful, because it's not a win. It's not literally a win, but it counts as a success in a way. The reason why I count saving losses as success is because I think one of my roles has been in life and in a specific job I had was to reduce loss. It's called the Kaizen effect. It's one of the few things I actually fully utilized from school, which was in economics. I learned this principle, which is a Japanese, I think it's a Japanese principle, or of Japanese origin. And essentially it's about reducing time waste, but also reducing costs. And one of the things I really appreciate, especially in life, is that as things get more expensive, you have to make decisions, constant decisions as well, about whether you want something or don't want something. You have to look at the opportunity cost of a thing. And what that simply means is I need to decide where to count my losses, where to shorten my losses. And one of the greatest things that business does is reducing cost. That's one of the best ways to increase your profit, is to reduce your cost. Because when you look at most companies, at least, I don't know about this new age, but in the prior age, one of the greatest expenditures of a company would have been / is wages. So one of the best ways of saving money was firing people, as long as they didn't have to give packages. Why? Because one person a year costs maybe, let's say, 100,000, because it's a round number. Cost of business 100,000. Just having 10 people, they're spending $1 million a year. Okay, what about massive corporations who have thousands of employees? Well, 1,000 times 100,000 is in the hundreds of millions, maybe even billions. So you have these companies spending hundreds of millions, billions a year on just people. So if they could get, for example, the same output with half of the staff, why would they not save $500 million or half, I don't know, 250 million? Just by, again, and they can get the same output, same revenue, same everything. So you got to see your life as a corporation. You got to see your business as a corporation. This is not just applicable to trading either, because it can be applied to multiple things. You need to constantly reduce your costs. Now, what's a practical example of how I can apply this in my life? Well, I used to order food every single day, like literally breakfast, lunch, and dinner. Why? Because I just felt like, what's the point of me cooking? For example, it will take me, let's say, an hour to cook a meal that I would enjoy, or an hour and a half. The time it takes me to cook that meal, I could have been doing something else. And that's still a good philosophy. But especially as a trader, when your revenue is not guaranteed, you do have to be careful. Because I have what I call it. I have a rough idea of how much I should be making a month. But some months I'm making losses. And so my bills, my expenditures, some of my costs, they are unchanging. So I have to control what I can, and what I can't, I just have to live with, right? So one of the things that changed was I was spending maybe £60 a day on food, and then maybe like £20 a day on travel. So that's £80 a day of spending, which doesn't sound that much, but it adds up. You know, that's £400 a week. That's 1.6k a month. And if I'm making maybe 2 to 4k a month, for example, that's half of my wages gone on just food and travel. So one of the things I implemented was learning how to cook, and I'm very simple. I like to have methods or like a strict plan or just a simple recipe. I don't like doing complicated, ever changing every day, Like there's certain things in my day that cannot change, right? So one of the things would be cooking, and I cook basically the same meal every day. It tastes different every time I make it because that's how bad of a chef I am. But it's consistently decent enough for me to eat, and I spend on the ingredients maybe £20 maximum a week, and then maybe like £30 if you include snacks and other meals and stuff like this. So £30 a week, from £60 a day to £30 a week is probably one of the greatest cuts. So just from making that decision alone, I went from spending on my food. How much did I spend on food? I would have been 300 a week, or like technically include weekends. It would be £420 a week plus minus, oh well, to £30. So I'm saving £390 a week just by me making that decision. And I consist even now, if I make, let's say, 100,000, I may not increase that, at least not immediately. So what's my point? My point is that when you treat your life like a corporation, when you treat your life like a business, you make business decisions according to your life, you can start seeing business results. What's some business results? Well, the more money you save, the more now I'm basically see as a positive, not a win, not an increase in revenue, but I'm seeing it as a positive because now I have an extra 400, for example, to now invest into myself or into something else. £400 is a gym membership. £400 is not more than a gym membership. It's a boxing lessons. It's singing lessons. It's learning an instrument. It's learning the language. It's buying a couple of books to read. It's maybe adding some more capital to my investments. Is stocks. There's a lot of things that £400 can do, and all I did was make one decision. But if you base that decision off a life decision, it's not rather. I didn't make a life decision. I made a life decision, a business decision, and I got a business outcome. And so you want to apply this as well to your training, which I'll get into in a second. Now, the reason why I am quote unquote air quotes waffling, I don't really see it as waffling, but the reason why I'm talking it like this is because, well, we're just monitoring Judas things right now, so we're not really trading per se. Like we're trading, but we're not actively in a trade. Okie dokie, right. Cool. So I'm applying to trading because I was going somewhere, but I don't want to go there right now. So applying that business decision to your trading style, what does that mean? That means that every single trade you make is a business decision. How do you make that the case? Well, first thing I alluded to was that you have to count it a positive every time you enter a trade or you don't enter a trade that would have made you lost your money based off of wrong principles. For example, you enter a trade that disobeys your plan, or you enter a trade based on emotion. Those are positives when you avoid such cases, especially when they are leading to losses. Even if they lead to a profit, let's say the trade you entered is of bad reasoning and it leads to a profit, you still have to count that as a positive, because sometimes I've been in a cycle where I've been reinforced I'm doing a good job because I'm getting money, but the thing is, in the long term, you're not, because you may be rewarded short term, but long term, the odds never lie. So we've had a sweep of the London lows, which are right here. So we can actually, I don't know if it hasn't loaded my, so I'm on my laptop right now, which is annoying because everything is saved on my computer, and for some reason it's not translating. Let's see if I can, it might leak something though. Wait, is it showing? It does show the tab. Oh, that's fine. Let me just double check if there's news. Hello, is my Wi-Fi good? Okay. What is happening? It's moving so slowly. Yeah, I'm being trolled. Install what? Okay, so today is Tuesday, 1:30 p.m., which is in 30 minutes. We have CAD news, which does affect USD, but we will mainly use it as fuel. We won't really like base our trading day off of it. Anyhow, excuse me. The first kind of things you want to do, like whilst I wait for markets to kind of the New York session to open, is to mark external liquidity, right? So the difference between external and internal liquidity. External liquidity is places where your traders or traders that are trading on a larger time frame are forced to close their trades. What does that mean? When you look at the larger time frames, there's people that are trading, the 4 hourly, the daily, the weekly. So they're not really in the market as much, but they are generally speaking trading in those time frames. Now the common denominator amongst these things, I say common, it's not every single person or instance, but there's some people that are holding these positions on these higher time frames that will have to be closed because they tend to be traders that have or trade with more capital. So what are those levels? What are those areas? Well, the external targets are the things like the yesterday highs and lows, the previous day's range extremes. So sometimes you may have if you look at this candlestick here, right? You see this wick, you see the body and the body. The body is the open and close, but the wicks dictate the extremes. Like this is an extreme, so there'll be some liquidity above here, and there'll also be a liquidity above this body, right? They're both external liquidity in their own rights. You also have 4 hour swing highs and lows because this is a very popular time frame to trade on. So there will be a lot of people saying levels at the peaks of these and troughs of these of this chart time frame. You then also one of the best ones, which is the first ones I learned, is equal highs and lows. So places like this where there's equality or equilibrium in terms of the height or the lows of the equality of the highs and lows, basically. So equality was the correct terminology. So yeah, and of course weekly highs and lows. So these are basically long-term areas that have key points of interest. Then you have internal targets, which is on the smaller time frames, but it's things like the London high. So the London high right here, this is an internal liquidity. This is not an external liquidity. This is important information. This is not external liquidity, right? Because it is a day's range. It's literally based off of 7 to 10, right? So it's about 3 hours worth of trading. That's not enough to be classified as external liquidity. It's not enough capital, not enough orders as an accumulation, as a total, for it to be classified as a external liquidity. When you compare it to a 4 hour high or a daily high where there's a lot more capital involved, yeah, it's not comparable. It's not comparable. Well, it is comparable, but the comparison is that it loses. Cool. Another place is random intraday swings. So obviously this is a high, but it's London high. This is a swing high. This is a high here. These are not liquidities, like external liquidities. These are internal liquidities, okay? Or 5 minute structure. That's also not internal liquidity, external liquidity. So that's internal liquidity. And it's very simple where you see the outer or the larger time frames as outer, the smaller time frames as inner. That's a basic rule of thumb. Okay. So, what is the difference between internal liquidity and external liquidity? We've analyzed the differences, but they both serve different purposes. For us and my trading style, and what we're going for, what we classify both as, or the importance of each of those types of liquidity. External liquidity is where we want to get to. So price moves towards, not towards, in fact, I would say moves to external liquidity. That means that our goals, our targets, our take profits, our aim is for price to get from one place to another, and that another is external liquidity. So we're basically analyzing every day where the price is going to get from where it's at to this external liquidity or this external liquidity. As you can tell, there's going to be external liquidity above and below. We just need to determine which one above or below is price going to. Price will then move through internal liquidity to get to the external liquidity. So those internal structures, those internal highs, those internal swings are what we will classify as internal structure and internal liquidity, and that's what price uses to get to the external liquidity, which is the outer range, the traders that are trading the larger time frames, the larger swings, etc. So that's key information regarding liquidity and how we utilize that. So if you look here, we've swept this internal liquidity. It's kind of annoying because does it wait? We'll just use the template here. So this I think there's a way to okay, I'm gonna spend like maybe 15 minutes just talking a little bit, right? So I don't like how it includes every single one. Okay, we'll sort it out later. For now, let's just run with this, right? So we're going to talk about direction, right? So now I said that we are looking for price to target external liquidity. So the first thing you want to do is when you find out how does New York reveal, how do you know when where price chooses this liquidity or this liquidity? How do I know which external liquidity price is going to go towards? So the first thing you need to do is to actually analyze where the external liquidity is, right? You can't know where someone's going if you can't know which direction somebody's going if you don't know where they're going. If you are a person that would know where someone is going without knowing their destination, you're just an observer. And that is where you lose money, because we're not just like, I can see prices showing signs of what's going down, but I'm not reacting to price. Why am I reacting to price? Or rather, why am I following price? This is the correct terminology. I'm meant to react to price, but I'm not meant to follow price. If price is following something else, I don't want to be following price, because then I'm delayed. And if I'm delayed, then the thing that price is following changes, and then price then reacts to that thing, and I'm reacting late. The price has barely moved by the time I've reacted. And the problem with that is then my stop loss and my take profits and my entry levels and all these things I'm inputting are going to be at the mercy of something other than price, not me. And that is a problem. So yes, my rules are what I would define as me. So my stop loss, my take profit, that's what I would classify as myself. But it's a myth. You're convincing, or the markets will convince you that you're in control because you're allowed to enter whenever you want. But that is the problem. You shouldn't enter whenever you want. You should enter based off of information. Now, where do you get your information from? You get information from liquidity. I find it's the best one because I used to trade like support resistance, trends, and this, that, and it works to an extent, but you will always be subject to something else. And I noticed a pattern in my losing, and I was like, okay, what is this pattern? And realized I keep getting direction. I was quite good at knowing where price would go, but when it will get there, how it will get there, I would always struggle with. And so liquidity or the ICT kind of trading methods kind of solves that, because it informs you and it gives you information as to why, and it shows you the patterns as to why and explains it. And you may say, okay, well, how do I know this person's telling the truth? Well, the person that I listen to, first of all, they have success. their mentees have success, and then third of all, they have experience. And then you got to see what motivates a person. Is it money? I used to want to be the type of trader that would show a lifestyle and try to get people to who want a similar lifestyle to follow my steps and how I got here. And there might be some of that in the future, but I'd rather win people through my characteristics or my character rather than a lifestyle, if that makes sense. And what is that? What's that lifestyle look like? What that characteristic looks like? So it looks like discipline, truth, transparency, honesty, integrity. All these types of things that a lot of people don't showcase. And I think that's my want. Anyway, back to the markets. We're getting closer to that 130 time period. Okay, cool. So, like I said, we're trying to reveal or determine where price is going to go, which external liquidity price is going to go. So the first thing you want to do is I'm going to show you all the types of liquidity, first of all, that classifies as external. So daily high of yesterday. Okay, I need to get into the market. I can't see. Okay. So yesterday's high. Yesterday's low. Should be oh, it was crazy. I actually wanted the previous, now it's giving me the new one. Oh, goodness. All right. Daily high. Ugh. All right, let's do this properly. It's a text, it's daily high. And then we're going to change the style to extend right. I'll make it gray. We can save that. Okay. Daily low. Actually, just make it. I'm gonna make it like this. It's a daily low. Oh wait, no. I want to put the text right. Middle. Hold on. Okay, it's working. Alright, this is how I want it. Sorry about the yellow. Middle. Okay, so this is first liquidity, external liquidity marks. It's the daily highs and daily lows, which is the previous candle. So you go to the daily time frame, you look at the previous candle because this is currently this day. And yesterday will be this daily high and this daily low. Next one you can go through is if you now establish this, it's extreme highs and extreme lows. Now in this instance, it will be places like maybe here, and then well, alternatively, it will just be the previous low. But I'm not gonna. I'm not gonna include this one for now. Let's skip this because otherwise are better. So previous day ranges, which is the high, yesterday's high and low. Then we go to the 4 hour. And we look for the swing highs and swing lows. So swing, swing, swing. This one counts as multiple because it's also equal highs. Okay, now it's working. See what? Oh, I see. I see, I see, I see, I see. I used a trend line. I was meant to use the horizontal array. Hmm. Okay, let's see what we got. Yeah. Okay. Yo. Okay. You then also want one for equal highs and lows. Let's create that template. It exists. Okay. So this kind of overlaps with these 4 hour swing high. Put it just below. So, yeah. Okay. Bam, bam, bam. Okay. Daily high, daily low, 4 hour high, equal highs. Bam, bam. Next one. Weekly high, weekly lows. So it'll be here. Let's keep it red for now. Okay, weekly highs and weekly lows done. So now we've analyzed all the external liquidities, right? So all of these lines are external liquidity. Okay, every single one of them. 4 hour lows, swing highs, 4 hour highs, equal highs, weekly highs, the daily high, the daily low. All of these are external liquidities, right? So we need to determine which one of these price is going towards. Okay. Now, how do you determine that? The first thing, like I said, is step one, which is what we just done, is to actually mark them off. So we've just gone through. So give me a second. I have to sign into my Google account. It's 1, it's 32 hours. All right. What am I going to do first? Probably. Okay, that's just not working. Okay, I won't be able to see the chat. That's so annoying. Ugh. Okay, as you can see my chat, I think. Okay, so now we've marked off. That's the first thing. Okay, there's 4 steps in total to find out which way price is going to determine liquidity. So the one pre-step is the timing, right? We know the determination of where price wants to go from the New York Open. Now, New York, not the literal minute it opens, but the during the New York Open and during the time when our sweet spot is 2 to 3 or the 3 to 4. No, it's 2 to 3. That's our sweet spot. Okay, so step one is London rate. So we need to go to the smaller time frame. You can see here we have the Tokyo session, London session, then it'll be New York, and that's always the order: Asia, London, New York. So step one is London rate. Okay, we start with London rate. Tokyo session, we never trade. This is midnight to 6 a.m. for us anyway. But what we analyze and we look for in this instance for the Tokyo session is literally this, right? So we have, hold on. Okay, cool. And then copy this over. Okay, so we have the Asia highs, Asia lows, right? That's internal liquidity, like we mentioned prior, but it's also where we start revealing direction, where price wants to, or the markets want to reveal direction. So we start with this. London session, the only thing that we do with the Asia session is mark this high and low. We then monitor if the London session sweeps the low or if it sweeps the high. What does a sweep mean? A sweep means where price closes above it with a body of candle and stays below it or above it if it's a high, below if it's a low, for at least a couple of candles, right? Generally speaking, but you don't want a wick or you don't want a an instant rejection per se. Like I'm talking within the same candle. You want to over the span of at least one candle, and you want it to close above cleanly too, because you don't want it to like just close like 1 or 2 pips above. That counts as an equal high. Cool. So that's step one. So London performance rate. This gives us the setup, not the direction yet, but it just tells you, for in this instance, that buy side liquidity has been taken. Directions is still not chosen. Okay. So step two is what's happening right now, which is the New York session open. So New York will, generally speaking, move in its opposite direction first, that it's wants to go in, and then it will truly go into its correct direction afterwards. So if the New York session wants to go up, when it opens, it will go down. If the New York session wants to go down, generally speaking, when it opens, it will rise first. Now, obviously, this doesn't always happen, but this is what we're looking for. Okay. After we get that move, so as you can see, New York is opening up. So let's say it goes up and it wants to take, for example, the London highs. Let's just grab this line in here. So let's say New York session goes all the way up here and takes this, right? Step three, after we've got that first move, that move will tell us where price wants to go. But we need a confirmation on top of that. Okay, so now we have the Asia highs and lows been taken out by London. New York open is moved in its false direction, which is the Judas swing. Okay, it takes out the London high, for example. That's 1, 2, step 3 done. But we need a confirmation that, okay, just because it's gone in the false, we need a confirmation that that's a Judas swing. We need also a confirmation that the price wants to go in opposite direction. Okay, and then once we have that fourth step, which is what we're looking for right now, we can then start to look to enter, because we can then determine, okay, you know what, price is probably going to head towards liquidity to the downside, and then we just target the nearest one of the external liquidities that we have drawn. So what is one of the cases, or the 2 cases that could, generally speaking, happen here? So New York could like rally up, take this liquidity, enter back into the range of London, and then continue downwards towards this 4-hour low down here. It could also dip. It can come back down. It's really taking these lows of London lows. It can come back down. It can rally, break the high, and stay above, and then continue going up. Then we'll be targeting external liquidity towards the upside. And the first one will be this, I believe, is that the daily high? Yeah. Which will be yesterday's daily high, which is about here. And this will mean that we have a bullish day, and then we look for entry, which is a market shift and a retracement to a fair value gap beyond that London range. Another example is it doesn't actually have to take London's liquidity. it could even just fail to close above London's highs, pull back into this area, we get a confirmation, and then it goes towards the downside. This means that London wasn't a reversal, but London was just a continuation of this downtrend that we've had from yesterday. And we can target external lows. So I use the word acceptance, but what does acceptance mean? Acceptance is where price, in this word, I know you can't use the word to describe a word, but it's where price accepts the direction it's going in, or it's a confirmation of where price is intended. Where price shows you that it means what it did. Sometimes you can have a high highs, high lows, but it doesn't mean anything. It means it could just be noise. But the way you know it means a higher high, high low is when it does it over and over and over again after a long period of time. Why? Because price is showing, yeah, it's not an accident. This is a purposeful move. So in our instance, because it's not necessarily high highs, high lows we're looking for, it is acceptance beyond the range or below or whatever it may be in the case of where it's relevant. But we're looking for acceptance for price to be outside of a certain range or within a certain range. So this is the blueprint to acceptance. One. In fact, let's start with what acceptance is not. Acceptance is not a wick, okay? This is not a wick. Acceptance isn't one candle. It's not a wick. Let's just leave it at that. But what acceptance is a displacement through a certain level. If I want acceptance below this range, I'll need a displacement. Displacement is where there's large candles like a fair value gap, a series of candles where they are all in one direction. For example, if it's a sell candle in my chart color scheme, it will be 3 big black candles towards the downside because that black represents going down. If it's a bullish displacement, it will be 3 strong, which is bigger than normal, blue candles going to the upside. It's also candles closing beyond the range. So if a candle closes beyond this range and holds it, then it's going to be going down. If it closes above and holds up, then we assume it's going to go up. That's what acceptance is. Or a fair value gap, again, like a similar to displacement, just forming beyond the range. Wick is a liquidity grab. A close is, generally speaking, a delivery. So when the New York opens, this is what the questions we ask ourselves. We ask ourselves, did price accept above or below the London range? So right now we're below the London range. So we need to see, okay, is price going to accept this? If it accepts this, we're going to continue going down. Then we combine everything at the end of this, which is how do we know which external liquidity is being targeted? We combine everything. So we have our priority list of external liquidity. Well, actually, I haven't given that to you, but it starts off with number 1 being the previous high, which is over here, and the previous low, which is down here, or daily low. Price always goes to at least one of the previous day high, the equal highs, equal lows, the 4-hour swing highs and lows, and the weekly highs and lows. Those are at least one of those, generally speaking, every day. Cool. So in this specific example of EU, what are we looking for? So London has raided the Asia lows. Now we're going to wait for New York, which is what we've done. Now New York has opened. Let's remove this arrow for now. So if the New York trades above London high, which it isn't, we'll then buy targeting yesterday's high, which is up here. If it fails to go above London high, which is up here, and drops below the London low, we're going to sell targeting the previous day low. Obviously the previous day low is up here, so we're already below it. So we'll be targeting this for our low down here. And yeah, so essentially this sweep came up down here, came up here, it's come down here, and like I said, if New York wants to go down, it'll go up first. If it wants to go up, it comes down first. So we'll be wary of it. Now, a Judas swing is when the New York opens initially. It's not a guarantee. It's not a guarantee it will happen. It's not a guarantee it will happen at that time. It can even happen for the whole day. It can happen not at all. But we'll analyze. We don't enter for the first 8 minutes because we know that that is the prime time for Judas swings to occur. Remember, 2 to 3 is our main time, which is in 40 minutes, of when we are trying to attack the markets. Cool. So that's just a breakdown of what we're looking for today, and it's a breakdown of how we're looking for liquidity first before market structure. Market structures are entry model. Fair value gaps and retracements to such are our entry model. But our direction model, which is determining where price is going to go, it's got nothing to do with market structure shift or fair value gaps on their own. It is where liquidity lays. Where is liquidity? That's the first thing, is where. It's like finding out. Like I said, if you want to be ahead of the markets, you want to know where the markets is going. That's the first thing. I've always been decently good at figuring out where the market is going to go, but how it gets there is where I struggle with. Now that's what liquidity helps with everything. Just by the direction model of liquidity, it helps you with everything, because it takes you around from confusing yourself. It breaks everything down. Once you understand it, on top of that, with the understanding, it allows you to understand where price and why price is doing what it does. Once you understand why price is doing what it does, it removes it from being a potential entry to just noise. When something is noise, you just ignore it, whether it's good or bad, whether you made money or lost money. Noise is noise. Now, when you classify something as noise, the difference between noise and a conversation, for example, noise is just sounds that don't provide a purpose for you. Not that they're not important, but it's not important for you, like background chatter. The person's conversation across the room in a cafe has nothing to do with your conversation, has nothing to do with you. Obviously, you might eavesdrop and they may say something important, but my point is that generally speaking, once you classify background chatter as background noise or as noise, you ignore it. Your brain does that automatically for you anyway. Or there may be someone horning, but you're walking down the street. I mean, generally speaking, it might get your attention if it's nearby and it's loud, but if it's far away, it's got nothing to do with you because someone's horning for something else. So that's why you don't want to be busybodies, because being a busybody means that you're almost like accepting noise that doesn't belong to you. But what matters for you is your headphones, your music, maybe people talking to you, maybe you're in a conversation with somebody. That's conversation. Why? Because you've analyzed that noise or that sound as an important sound, or a sound that you register as something that you need or something that is relevant to you because the person's talking to you. We do the same thing in the markets. Everything that is outside of our model is noise. Yes, people can make money, people can lose money. We do not care about that because it doesn't exist for us. It's not important to us. It's noise. What is important for us is what we've laid out or what we've established as our conversation. We are trying to talk to the markets. We're trying to talk to the markets in a certain manner. We're not trying to talk. You can even have a conversation with a person and only want to talk to them about certain things. You don't want to. There's some people in your life that you don't talk about certain things to. Maybe it's you don't trust them, and you don't want to talk to business about a person. Why? Because you don't want to lay your secrets out there in the open to this person, because they may use that information for something that you don't want. So that's why you kind of establish a range or boundary with sometimes even the person you're talking to. We do the same thing for the markets. Right. Also, I mentioned, well, there's news, isn't it? I mentioned that 2 o'clock to 3 is our entry time. It's actually 1:30 to 3. Obviously, 2 to 3 is better, but that's like the golden hour, I would say. But the moves that are the cleanest tend to happen between 1:30 and 2:30. That's when they begin. After 2:30, if we don't see an open, we generally speaking leave it. So yeah. Right, so just looking at the markets. It's probably my last analysis for a minute. I'll probably have to end stream a little bit early, around 2, 3-ish latest. But I might be silent for a while. I'll have to do some other things. But this is my current posture. Excuse me. So Asia's, this daily low right here, we've been operating at it since practically Asia's opens. Asia displaced, taken out this previous daily low, retraced to it, fell back down, retraced to it again, displaced again, even taking out its own lows. And then there was a sharp reaction, taking out these highs over here. And that London session failed to create to break the Tokyo session highs. So that is fuel, or not fuel, but information that, okay, price probably wants to go down. And it's also at the daily lows of yesterday. Then price drops again, comes back here. After London session open, before New York session opens, we displaced downwards, taking out these London lows right here. So we've taken out the previous daily lows, we've taken out the Asia lows, taken out the London lows, and we're currently hovering around here. So a couple of things can happen. These should have released by now, right? Yeah, it was negative for CAD. Which generally speaking, I think is positive for USD, or sometimes they go in alignment. Anyway, we've taken out all of these lows: daily low, Asia low, London low. Currently, the New York is below this London low. Okay, so now it's swept it. We need to ask, will it stay here? Because this displacement before the New York open could be the Judas swing. Now, Judas swing is not a, it's not a law. It's not a, it has to happen at this time. At the first 30 minutes of the New York session is always a Judas swing. We just don't trade it because that's our rule book. However, this could also be the Judas swing. Now, if this is the Judas swing, it could contribute to price going up. Now, I've said all these things. We've broken lows after lows after lows. Why am I still potentially having the idea that price could go up? You need to be careful because price, what we're basically monitoring, just without the text. Okay, here we go. So what we're basically monitoring is if price wants to stay below this level right here. If it stays below this level, we'll be looking at price to continue going down. If we come back up, especially if it's in the next couple of candles, it was fun buying. Why? Because we've taken all of these sell side liquidities. It is all fuel. It could be counted as fuel to target the external liquidities to the upside, such as daily high over here. So I'm gonna go through that again. So we're already below the yesterday's low. London session took Asia liquidity to the downside. We had displacement to the downside before New York, and now New York is sweeping London lows. And we are now, or rather statistically, we're leaning towards a sell side liquidity run, which is what we've basically been doing, to then a New York reversal attempt. Obviously, it's not guaranteed, but we don't trust this first initial bearish move right here. We just need New York to prove that this bearishness is what it wants to do for the day by it maintaining below this London low right here. So the key is that we don't enter within this range. We would only enter buys above the London high or sells below the London low. This gives us that extra confirmation, right? So if we are waiting for a pullback, or if we're looking for New York and it's potentially making a pullback, it would have to remain below this London low here. If we pull back within the range, we don't enter because we know that price could rally up to the upside, take up this liquidity. Then we watch and say, okay, cool, price then stay above the London highs. If it stays above the London highs, we can then enter buys towards this daily high, potentially even these equalize up here. But if price maintains below, which doesn't look likely, then we'll potentially be New York saying that we're accepting that, okay, we're comfortable below this price. Let's go to the downside, tell these 4 hourly lows over here. So that's currently our posture. We can go either way, but we need confirmation. Our confirmation is acceptance. Is price going to accept it being lower than the London lows right now? Now, the most likely scenario is that we enter back into the range, accept that we're not going down, and then enter some longs. Well, it would have to rally or take London highs. Okay, last thing. As we move from direction to bias, well, not bias, sorry. Our bias is our direction. But as we move on from there to execution, this is the last point before we start looking at some opportunities, hopefully. So now that we, generally speaking, should know where price is going, the only thing that we're waiting for literally is going to be acceptance. But we need to first set some rules as to our entries, our entry model. So the first thing is when price is inside the London range, we don't enter. Because the London range is going to be our decision box, our area where we are deciding where price will go. Inside of this range, there's going to be both sellers and buyers. So that's why we are careful. So the algorithm will be collecting orders within here. So we need to be careful which side we choose because we don't have control technically if we were to enter either side, since there's a mixture of both. That means that any market structure shift, any fair value gap, any order block that we have inside that zone, which I can see a fair value gap right now, we do not treat that as a high probability trade because we're basically trading the equilibrium. We're trading at the, the norm or let's just keep it as equilibrium. Inside the London range, there'll be a lot of manipulation. Outside the London range will generally speaking be the delivery. We want to always target delivery. So our first hard rule is that we do not take trades inside the London high or low unless New York has already accepted the direction. Okay, that's why we don't. If we have a clear direction, okay, price is going here, then we can enter in the London highs slash lows or the London range, let's call it. So, for example, if price was to now pull back into the zone, I would contemplate entering just because I'm not happy with this acceptance. It's a lot of wiki, it's not strong enough. If we hold here for like a couple more candlesticks, then we pull back into this fair value gap, then I could potentially start looking at lows because we have acceptance. Okay, so what will classify acceptance? We've spoken about it quite a bit, but let's go over it again. Acceptance is not a wick, so this is not acceptance. Acceptance is not one candle spike. Okay, acceptance is the market being comfortable trading at a level. So we need to see comfortability. So we don't need to complicate with indicators. We just use behavior. How is price behaving? Behavior is not like a blanket. If you have a child, or if you see any child, it doesn't have to be your child. Every child is different. And so the way when two children may be doing the same thing, but it counts as different behavioral patterns or different behavioral expressions. For example, someone that's normally quiet, for them being quiet is not them being a certain way. That's just how they are naturally. They're quite a shy person. Another child being quiet could be that child being upset because they're normally a loud child. They're normally quite expressive. So if they're losing that expression, that means something would have happened. See how two different children are doing the same thing? One child is being quiet because that's how they are. Another child is being quiet because they're not allowed to express themselves or something upset them. Same behavior or same expression, different behaviors. So when we see this, obviously, once you start trading a certain pair over time, you begin to learn how it acts normally. But here, acceptance looks different in different pairs, number one. Number two, we're just looking at behavior. So now I can see, okay, price is held. That we saw some buyers try to push price up above the London low, but it seems price is holding below it quite well. So if we want to see bearish acceptance, things we want to see is, first of all, it takes the London low, which is done. Small pullbacks only. It stays below the London low and it fails to re-enter the range, and it continues to form lower lows below it or lows below it. So what are some practical rules? So it's 1:30 where we start trading. Between 1:30 to 2, if it spends about 10-20 minutes below a level, we can classify that as acceptance. It's not an exact number, but we're observing stability. So things like multiple candles, that gives us stability. We're not monitoring just one wick. That's not stability. And obviously the same would be for bullish acceptance. Okay, this is good. I think price is going down. So what we want now is displacement, and then a bearish displacement, and then pull back towards that displacement. Then we can target these 4-hour lows right here, and we can put a decent amount of confidence in this trade. So see how much depth goes into just entering one trade? You have to manage yourself so much. That's why it's important to have rule sets, which I will be creating a complete playbook where even if you don't even understand what is going on, with the training setups, if you just copy and paste the playbook, and you make it, it's like a decision tree. If you copy it, you would, or follow it rather than copy, because you'll be your own trades. If you copy it, you will be able to determine how to enter every trade every single time. And once that's now done, you can literally trade that setup over and over and over again, and then gain understanding as you're trading. Cool. Another rule of thumb is this London low is acting as a resistance, which is great news as for people that are expecting acceptance. Let's combine everything, okay? Excuse me. We don't enter on the sweep. We do not enter on the first candle. We do not enter immediately on the market shift. Okay. We enter after market completes a 3-step process, which is 1, a liquidity rate. That's step 1. Step 2 is displacement, a strong impulse to move away from that level. Okay, which is what we're waiting for right now. So we've had the sweep, we're waiting for the displacement. Displacement tells us that institutions are entering. That's core information right there. Then step 3 is we now wait for the retracement into this imbalance, which is the fair value gap, the order block, liquidity void, all these types of things is what we wait for. We enter on the pullback, not before. Do not skip that. That's important. We're not institutions, so we cannot enter like institutions. Yeah, I'm gonna have a look at some other pairs. We're not getting the displacement that we're looking for. Okay, London. How's it taking here? London over here. Low key. I think GU looks a bit cleaner. We displaced during London. Pulled up. Displaced all throughout Friday night, New York. Wait. So this displacement does not actually include New York. Hold on. Right here. I think we can enter this. I'm not gonna lie. Such a tight leg. So my trading account. Anyway, there's no way I missed this, right? Oh my day, yo, I've been trolled, man. Oh my, that was so slow. Does it have my login details in? Okay. So let's go back my screen while I log in. I'll explain in a second. Hold on. Well, USD is rising and fast, but it's selling my entry. Okay, authentication code. Give me one. Okay. Verify. Ali. I don't know how long this will stay next to my entry. Trust and proceed. Yo, this could not be any slower. Dude. Yo, I'm over joking. This is doing that 2 miles per hour. I think that should be enough. Or like, let's do this. Come on, price is dropping. Okay, deposited. Come on. Okay. Look where we could have got in. Oh my gosh. Gold is okay. Wait, give me a second. I'll show screen. Oh my. I need to get a screenshot of this. I don't deserve it. Still, you give yourself. All right, here we go. We're going to this trade. We deposited now, so yeah. Do I have Telegram on this? Can't do that. Okay, we have a bearish day. We've analyzed sales. Yo, my laptop is. I might actually invest in a new laptop. I'm never joking. Okay, whilst that's loading, let's find some external liquidity which will determine our targets. Okay, so first of all, we start with the dailies. To be fair, there is liquidity over here. Wait, that's not daily. Okay, we're already up like a lot. Okay. Yo. Well, what a weekly though. So we're done here. You're getting a little bit late. Where I actually got in. What you say? Perfect in all of your ways. Yo. Alright, so where I actually got in, according to my broker, is oh no, all the way down here. It's crazy, dude. We didn't get any delivery here. Gold plummeted. Okay, swept. Okay, I think price reversed it. We also have another potential entry. So our first ugh, target is this 4 hourly low here. It's TP1. Next, where is the next? Probably here. Close this at least. All right. Okay, so we're gonna call it a day here. This is the trade we're in. We're just gonna watch it, make sure we're good, and we're targeting this low and this low. Okay, so that's a risk to ratio. If you go in at the time I called it, it's a 1 to 4.68, which you can take everything out here, which is fine. That's a 4.6% day, and then I'll be looking to see how it reacts to that zone, and then see if I want to target this, which is a 1 to 9, which will then also be 9% there. So I'm gonna take maybe at least 70% at this 4 hour level. Definitely setting to break even, and then see if I want to hold to that 1 to 9. But that being said, we are done for the day. We did all of that analysis just for this one trade. So this will determine whether we win 1 to 4 or if it's a sub loss of 1%. So yeah, I mean, we did all of this waiting, all this analysis for a one decision. You didn't give us the delivery we wanted, or at least the entry we wanted. We saw acceptance, we just didn't see any displacement enough for us to enter now. There is a window of 2 to 3, but I'm going to just maybe add another percent to this order, and then just monitor this instead of re-entering again. I don't think I could even enter again. I had an issue with my account. I think my stop loss. I don't know what happened to my trade yesterday, but I did not risk that, and it had the swap charge as well. So that means it would have held overnight. It was the wrong stop loss I was put, so I lost a lot in that trade. I'll look at it and see where I went wrong. Maybe I put the wrong numbers. But for now, we just monitor this. I'm going to end stream because I have so much to do today, and I need to leave where I'm at 5 to get somewhere for 7, which is in 3 hours. 3 hours I need to leave. I need to eat and go shopping and buy some stuff. So there's a lot to do. So I'm going to end the stream a little bit early. If you're in my Telegram, you'll be able to see what happens to this trade. We are going to monitor it, of course, and then we'll update you as we go along. But yeah, thank you guys for tuning in. If you're watching this back, shout out to you as well. This is the trader we're in for the day. This is our target. This is our second target. I'm just going to set an alert so I know when to check my phone. So yeah, thank you guys once again, and I will see you guys tomorrow. I'll probably be streaming a little bit longer and earlier tomorrow. But yeah, thank you guys. Peace.